So we are in part 2 of PPE. Part 1, we looked at initial recognition. We first of all looked at objective. We said objective of PPE is to prescribe the accounting treatment. We looked at recognition of PPE. We recognize PPE when it meets 2 conditions. Probable that future economic benefits will flow to the business entity, and number 2, cost can be measured reliably. And we said that when you are recognizing, there are 2 ways of recognizing. There is what we call initial recognition, and there is subsequent recognition. In the previous session, we looked at initial recognition. We said under IAS 16, PPE should be recognized at cost, should be initially recognized at cost. And then we said cost includes purchase price, directly attributable cost of bringing an asset to its present location and condition, dismantling, removing, and restoration costs, and borrowing costs to be capitalized. Now, initial recognition is recognition for the first time. Now, what do we do in the recognition for the second time? So under recognition for the second time, IAS 16 gives you 2 options. You can either use what we call cost model, or you can use revaluation model. So there are 2 methods you can use in subsequent recognition. What is subsequent recognition? Recognition for the second time. So you can either decide to use cost method, or you can use what we call revaluation method. I hope that background is sufficient. Now let's start with cost method or cost model. In this method, an asset is carried at carrying amount. I'm paraphrasing that sentence. An asset is carried at carrying amount. So what is carrying amount? Cost minus accumulated depreciation minus any impairment. So under cost model, if you want to know the value to show in the balance sheet, to the value to show in the statement of financial position, you take cost of an asset, you less accumulated depreciation, you less any impairment. Remember, under initial recognition, it is recognition for the first time. There is no depreciation. Depreciation starts after the asset is brought into use. So depreciation can only affect subsequent. It cannot affect initial. I hope that point is clear. Depreciation only affects us after we have brought the asset into use. When you are posting the asset for the first time, there is no depreciation. Now, the second point is also important. The adoption of cost model does not mean you will not revalue the asset. You can decide to revalue the asset, but when you are posting it in your books, you post it at carrying amount, at cost minus accumulated depreciation. But you note somewhere that the new value of the asset, the fair value of the asset, the revalued amount of the asset is maybe XYZ, but you don't post it in the balance sheet. You post it maybe to the notes to financial statements. So that is what point number 2 tells you. The adoption of the cost model does not mean that the asset is not revalued. Point number 3, depreciation is charged from the time the asset is brought into use. I've already explained that. Now, in financial reporting, I'm assuming, or financial reporting assumes that everyone knows how to calculate depreciation. Depreciation calculation is in financial accounting. So you are being told IAS 16 does not prescribe the depreciation method to be used, but it recommends 3 methods. So IAS 16 recommends that when you are depreciating an asset, you can use number 1, straight line method, number 2, reducing balance method, and number 3, sum of digits method. Remember, these methods are below us. They are in financial accounting. So remember, in cost model, I'm just reading the charts. I have already explained Mugisha Gad, I've explained dismantling, upgrading, and modification. I've explained them over and over. There was even somebody who asked a question and I think I had explained it. It's part of the cost of an asset. Okay, let's move on. So it's part of the cost of an asset. Dismantling is a cost you incur once the life of the asset is over, to remove the asset from where it was, to dismantle, to break it down. If it's a house, to demolish the house, that is to dismantle. Removing is the cost you incur to remove whatever you have dismantled from the site. Restoration is to return the ground in the condition you found it. Can we please move on? Okay. Now, there is also the second method called revaluation method. Remember, in cost method, you take cost minus accumulated depreciation. In revaluation method, in this method, PPE is carried at revalued amount. Revalued amount is the market value of the asset at that time of revaluation. It is the fair value of the asset at that time of revaluation. So revalued amount is the market value of an asset at the time of revaluation. So the revalued amount is always equivalent to the fair value at the date of revaluation. So the fair value, what is fair value? Selling price minus selling costs. So revalued amount is equivalent to the fair value. That is the take-home point. Now, whenever you are performing revaluation, and this is a common area in exams, whenever you are performing revaluation, there are 4 rules you must take into consideration for you to use the revaluation method. Number 1, when an asset is revalued from a certain class, all assets in that class should be revalued. What do you mean by that? If, for example, in your business, you have 10 cars, you have 10 motor vehicles. When you decide to revalue one motor vehicle, all motor vehicles must be revalued. Don't value one and leave out the others, because the motor vehicles are in one class. If you have 5 houses, when you decide to revalue one house, you must revalue all the other houses. That is what the first point tells you. When an asset is revalued from a certain class, then all the assets in that class should be revalued. The second point talks of consistency. You must be consistent in your period of revaluation. What do we mean by that? If you decide that the policy of your company, revaluation is done after every 3 years, ensure after every 3 years you do revaluation. If you decide the policy of your company, revaluation is done after every 2 years, ensure after every 2 years you do revaluation. Don't do 2 years and then you skip, again you do after 7 years. No, you must be consistent in the period of revaluation. So that is the point number 2. Revaluation should be carried out consistently over time. Point number 3. Once you get what is called revaluation surplus, the increment in the value of the asset, what we call surplus, what we call revaluation upwards. This revaluation upwards or surplus should be taken to equity in the balance sheet. So, and it is called revaluation reserve or revaluation surplus. It's posted under revaluation surplus or revaluation reserve. In which section? Under equity in the statement of financial position. So the surplus is taken to revaluation reserve or surplus under equity in the balance sheet. The fourth point, a transfer from revaluation surplus account to retained earnings should be made in relation to excess depreciation. What do we mean by that? For example, if you find that your revaluation surplus is 10,000, if your revaluation surplus is 10,000 and the remaining useful life of the asset is 10 years, you will take the revaluation surplus of 10,000, you divide by 10 years. So that gives you amortization of revaluation of 1,000 per year. So at the end of every year, you'll be transferring 1,000 from revaluation reserve and you take it to retained earnings. That is what point number 4 is telling you. Please find a way of mastering these rules of revaluation. What is rule number 1? When an asset is revalued from a certain class, all the assets in that class should be revalued. Point number 2, revaluation should be consistent over time. What is point number 3? This amount of revaluation surplus should be taken in equity, and you can call it revaluation reserve account or revaluation surplus. And point number 4, this revaluation surplus must be amortized over the remaining useful life of the asset. And every year, there is an amount you transfer from revaluation reserve to retained earnings. Now, accounting for revaluation, I'll explain it through an example. Recognition, also through an example. I'll cover it through an example. So let's go to derecognition. There is an example I'm about to cover. Let's go to derecognition of PPE. Now, PPE should be derecognized. What is to derecognize? To remove it from the balance sheet, to remove it from the financial statements. PPE should be removed from the financial statements. In other words, should be derecognized if number 1, it is sold. Number 2, it does not generate any future economic benefits. So PPE should be recognized, number 1, when it is disposed, you've sold it. And number 2, it no longer generates you any economic benefit. Sir, Richard B., when revaluation is known to be access, what do you mean by access? What do you mean by excess revaluation? Okay, there is an example I'll do. I think I'll answer you through the example that I will do. Okay, I'll answer you through an example. Don't worry, hold your horse. Just don't worry, I'll explain that. Now, finally, there is what we call disclosure requirements. When you are accounting for IAS 16, what should you show in your notes to the financial statements? Number 1, the measurement basis used. Did you use cost or did you use revaluation? You must clearly state the measurement basis you used. Number 2, you must show the depreciation method you used. Did you use straight line or reducing balance or sum of digits method? Number 3, you must show the useful life of the asset because it will affect the depreciation to be done. Number 4, if revaluation was done, the method that was used for revaluation. How did you revalue the asset? And number 5, a reconciliation of movement of items in the PPE. In other words, the PPE movement schedule. What is the change in the value of PPE? It's shown in the movement schedule. Please, the next slide, it causes the difference in exams. Now, in any question on subsequent recognition, please understand me very well. In any question in subsequent recognition, not initial, subsequent, there are 4 steps that if you follow, you will always get all answers right. There is a summary in this case, in this slide, the next 2 slides, of the steps you need to follow if you want to know the amount to take to the balance sheet, the amount to take to the income statement, and the amount to take to statement of changes in equity. Please master these steps. There are 4 steps. Step number 1, calculate the carrying amount. How do we calculate the carrying amount? Carrying amount is cost of an asset, you less accumulated depreciation. Step number 2, calculate recoverable amount. How do we calculate recoverable amount? It is the higher of fair value and value in use. you choose the higher of the two. Step number 3, compare step number 1 to step number 2. That is step number 3. Compare the carrying amount to the recoverable amount. Now, is it Richard who asked me that question? Now I'm answering you here before I go to an example. Richard, how do you know there is revaluation surplus? If the recoverable amount is more than the carrying amount, there is revaluation surplus. I'm repeating. If the recoverable amount, step 2, is more than step 1, there is a revaluation surplus. But if the carrying amount is more than the recoverable amount, there is a revaluation deficit or downwards. I hope we are together. I'm repeating. If the recoverable amount is more than the carrying amount, there is revaluation surplus or revaluation upwards. But if the carrying amount is more than the recoverable amount, there is revaluation downwards. So I hope I've answered the person who asked that question. When a company purchases used car at 5 million and it has book value of 2 million on book of the seller for guidance of depreciation at cost, which amount will be recorded in the financial position of the buyer? You record the amount at which you bought. The person who has asked that, you record the price at which you have bought. I hope I've answered you. And then you start charging depreciation depending on the remaining useful life. So when you buy an asset that is already used, that is the question somebody is asking, what amount do you record in the books of the buyer? You record the price at which you bought the asset. Now, step number 4. So let's go to step number 4. Step number 4, accounting treatment. Remember in step number 3, we have said it can either be a revaluation surplus or it can be a revaluation deficit. Now, accounting treatment, how do we treat surplus? Surplus is also known as upwards. So surplus, you debit asset and you credit revaluation reserve. The asset value will increase if there is revaluation upwards, and the revaluation reserve will also increase. Remember, revaluation is reserve is equity. There will be an increase in equity. When equity increases, you credit. There will also be an increase in asset. When asset increases, you debit. So you debit asset and you credit revaluation reserve. But for revaluation downwards, you debit income statement and you credit asset. For revaluation downwards, you debit income statement as an expense. So the amount of revaluation deficit or downwards is taken to be an expense in the income statement, and you credit asset because the asset is reducing. Now, suppose in the first year, you had revaluation upwards, and in the second year, you have revaluation downwards. I'm repeating. Suppose in revaluation in the first year, you had revaluation upwards, and in the second year, you have revaluation downwards. How do you account for such a transaction? You will have 2 debits and you'll have 1 credit. Because it's a revaluation downwards, the amount by which the value has come down, you credit the asset with the total amount of revaluation downwards. But there will be 2 debit entries. You will clear what was in the first year in the reserve. Because in the first year, it was a revaluation upwards, which we credited revaluation reserve. And now in the second year, it's a downwards. So you clear what you had in the reserve. Once you clear what was in the reserve by debiting the revaluation reserve, the balance you take to the income statement. The balance you take to the income statement. Don't worry about that. There is an example. Please, let's be attentive. Give me around 20 minutes. 20 minutes because I want to finish the standard. So we have finished the standard. We only just want to look at an example which is long, and then we end the session. So that brings us to the end of IAS 16. But we have an example we need to look at for 20 minutes. So just give me 20 minutes. We look at the standard so that we finish it. In the next class, we cover another standard. Is revaluation upwards the same as revaluation surplus? Yes, it is the same. David, it is the same. Okay, let's now read the question. Please, let's be attentive in this question. Very attentive. Smart acquired a 12-year lease on property. So which means Smart did not acquire this property permanently. They only acquired it for a period of time. Sometimes most of the some properties, there is no properties. Some properties normally acquired through a lease, but others are acquired full-time through what is called freehold. So let's read the question once more. Smart acquired a 12-year lease on property on 1st October 2000 at a cost of $240,000. The company's policy is to revalue its property to their market value at the year end. So at the end of every year, we revalue the asset. So they are using revaluation method. The company's policy is to revalue its property to their market value. So we said market value is the fair value, if you remember. So at the end of every year, we value the property to a new fair value. Accumulated amortization, we are using the word amortization instead of depreciation because it was a lease. But if you had acquired the asset permanently, we could not have used the word amortization. We could have used the word accumulated depreciation. So if it is an asset that you have acquired forever, you don't use amortization. You use what? Depreciation. So let's read. Accumulated amortization is eliminated and the property is stated to the revalued amount. Annual amortization. So where there is amortization, you can think of depreciation. Annual depreciation, but we are supposed to use amortization, is calculated on the carrying values at the beginning of the year. The market value of the property, remember we acquired on 1st October 2000. So at the end of the first year ends, a year that starts on 1st October 2000, that year ends on 30th September 2001. So on 30th September 2001, and 2002 were, the market value at September 2001 and 2002. In other words, the market value or the fair value after 1 year and after 2 years was $231,000 and $175,000 respectively. So in 2001, the market value is $231,000. In 2002, the market value is $175,000. The existing balance on the revaluation at 1st October 2000 was $50,000. So the revaluation reserve at the beginning of the year was $50,000, and this related to some non-depreciable land whose value had not changed significantly since 1st October. Please listen to the questions very well. Requirement 1, prepare extracts of financial statements of Smart Limited including movement in revaluation reserve. In other words, prepare extract of income statement, prepare extract of statement of changes in equity, and prepare extract of the balance sheet. That is what you are being told for 2 years, 2001 and 2002. I'll come back to that because that is calculation. B, explain how initial PPE should be measured. This is theory, you can now read on it. How should initial PPE be measured? Can somebody answer me in the chat? Explain how initial PPE should be measured. What did we say? I'm waiting for a response in the chat. PPE should initially be measured at, chat please. Thank you. At cost. So to earn the 2 marks, you don't only say at cost, you say initial PPE should be measured at cost. And then you say cost includes, number 1, purchase price, number 2, directly attributable price of bringing an asset to its present condition and location, Number 3, dismantling, restoration, and removing costs. And number 4, borrowing costs to be capitalized. That is the 2 marks. Number 2, the circumstances in which subsequent expenditure on those assets should be capitalized. We said subsequent expenditure should be expensed unless there is an evidence of improvement on the asset. What are the evidence of improvement on the asset? We gave 4 evidences. Read on them. Modification, upgrading, extension to a building, etc. You remember those points. That is 2 marks. Point number 3, or C. Explain IAS 16's requirement regarding revaluation of NCA and accounting treatment of surplus and deficit. So part C has got 2 parts in it. Explain IAS 16's requirement regarding revaluation of non-current assets. IAS 16 requirements regarding revaluation of non-current assets. There were 4 requirements. When an asset is valued from a certain class, all the assets in that class should be revalued. Point number 2, revaluation should be consistent. Point number 3, revaluation reserve should be taken to equity. Point number 4, there should be a transfer from revaluation reserve to retained earnings. So that is part C, the first part of part C. But you are told, and the accounting treatment of surpluses and deficit. We said for surpluses, debit asset and credit revaluation reserve. For deficit, debit income statement and credit asset. But if it is revaluation downwards for an asset that was previously revalued upwards, you debit revaluation reserve, you debit income statement with the balance, and you credit asset. Let's solve this question. 15 more minutes. So let's solve this question. Let's solve part A of the question through Excel. The same question, we have it here in Excel. What I was explaining to you, I've already put it there because it's theory. Part B, I've already put it there because it's theory. Maybe let me remove it from here. And I post it here. The theory part, I just post it here. Sorry. Okay, so I was just creating room to make my work presentable. So I'm in part A of the question. Let's be extremely attentive here as we wind up, but it will take us some 10 minutes or so. Okay, so let's read once more so that we get into context. Smart Limited acquired a 12-year lease on property on 1st October 2000. So the lease was acquired on 1st October 2000. So in my starting point, so that I move fast, there is the okay, so there is the date of acquisition. Date of acquisition. So our date of acquisition of the asset, date of acquisition was 1st October 2000. So that was our date of acquisition, 1st October 2000. Now, what is the first year? First year ends First year, remember, is from 1st October 2000 to 30th September. It is important to note these things. 1st September 2001. That is first year. Second year runs from 1st October 2001 and it ends on 30th September 2002. So that is the second year. So when we are calculating, remember, prepare extract of financial statements of Smart Limited for the year ending 30th September 2001. So I'll start with the first year. First year. We do the calculations for the first year. So in the first year, if I want to account for the first year, remember, we said there are 4 steps. Let me read what is in the chart. Okay. Okay, there is no question in the chat. So we said there are 4 steps you should follow. Step number 1, we said calculate the carrying amount, if you recall. Calculate the carrying amount. Calculate the carrying amount. Now let me use the abbreviation CA. Carrying amount, let me call it CA. Now we said that carrying amount is equals to cost of the asset minus accumulated depreciation. I believe you remember that. Now you need to find, please, whether you understand the question or you don't, follow the 4 steps we learned. If you follow the 4 steps, you will always turn out to be right. So cost of the asset is equals to, the cost was 240,000. Cost on the date of acquisition is 240,000. So the cost of the asset is 240,000. Now, next we need to find what is the depreciation. Accumulated depreciation. Now remember, depreciation is we are at the end of the first year. So what is our depreciation? So our depreciation will be, the lease was for a period of 12 years. So our depreciation, or I call it accumulated amortization, because it is a leased property instead of depreciation. But I hope you will remember that it's supposed to be amortization. But let me just leave depreciation because it's easy to remember depreciation. So it is 240,000 divided by 12 years. So 240,000 divided by 12 years. So that gives you 240,000 divided by 12 years. So that gives you 20,000. So what is the carrying amount? Carrying amount is the same as the net book value. So carrying amount will be equals to cost of the asset minus accumulated depreciation, because we are at the end of the first year. So that is the carrying amount. So the carrying amount is cost less accumulated depreciation. That is step 1. So that is step number 1. Let's go to step number 2. Can somebody type for me in the chat? What is step number 2? What do we find in step number 2? Response in the chat so that the forum is participative. Step number 2, what do we calculate? I'm waiting in the chat. Thank you. Amido, recoverable amount. Recoverable amount. Thank you. So calculate. Please, let's practice until we master the steps. Calculate recoverable amount. Now, what is recoverable amount? Let me call it RA. RA, to save time on that. So what is our recoverable amount? Recoverable amount is the higher of fair value and value in use. Remember, we are in the first year, at the end of the first year. And what is the first year? The first year is that. The first year runs from 1st October to 30th September. Now, what is the fair value? Fair value on 30th September 2001. What is the fair value? Let's read this second paragraph. The market value of the property on 30th September 2001 was 231,000 and 2002 was 175 because of the word respectively. So the fair value is 231,000. Value in use is not given. So if it is not given, you take it to be 0. Remember, what is the value in use? The cash flows to be generated from use of the asset in future. The cash flows to be generated from use of the asset in future. So the higher amount is fair value. Therefore, RA is fair value FV. So therefore, recoverable amount is fair value, which is 231. The higher amount is 231. So our recoverable amount is 231. Okay? So let me write it in full here so that recoverable amount is 231. Step 3. Step 3. Can we type in the chat again? Step 3. I want us to participate as we wind up. Thank you. Compare carrying amount to recoverable amount. Compare carrying amount to recoverable amount. So carrying amount is equals to, carrying amount is 220. Recoverable amount is equals to 231. So carrying amount is greater than recoverable amount is greater than carrying amount. Therefore, there is revaluation upwards. Upwards is also called surplus of 11,000. How did I get 11,000? 231,000 minus 220,000. I hope that is clear. When do we have revaluation surplus again? When do we have revaluation surplus? Revaluation surplus or upwards arises when recoverable amount is greater than carrying amount. When the recoverable amount is greater than the carrying amount. Step number 4. Step number 4. What is our step number 4? Step number 4 is accounting treatment. Now, accounting treatment will be debit asset account and credit revaluation reserve or surplus account. So that is the accounting treatment. So you debit asset by 11,000 and you credit revaluation reserve also by 11,000. Now at the end of year 1, at the end of year 1, there should be a transfer. Remember the last point on rules of revaluation. There should be a transfer of amortized revaluation, a transfer, let me call it of excess depreciation instead of amortized depreciation. There should be a transfer of excess depreciation of 1,000. I'll explain how I got 1,000 from revaluation reserve to retained earnings. I will explain. So we said you take the revaluation, you divide by the remaining years. Remaining years at the end of year 1 is, remaining years is 11,000 divided by 11 years, because the total was 12 years. And at the end of year 1, we are remaining with 11 years. So we take that 11,000 divided by 11. That is how you get that accounting treatment. That is first year. I'll repeat the same. Let me copy and paste to save time. I'll repeat the same for year 2. I'll paste the same. But now I'm looking at second year. So I'll only be editing so that I save time. Second year. Let's be attentive in the second year as I wind up. Now, in the second year, you are being told the company's policy. Look at the second sentence. The company's policy is to revalue its property to their market value at the year end. So at the end of every year, we revalue the property to their new value. So you revalue the property. Revalue property at the end of each year. Now, what was the revalued amount? So we will get the revalued amount at the end of year 1 is the fair value of year 1. So what was the fair value of year 1? Fair value of year 1. What was the fair value of year 1? We had it here. The fair value of year 1 was 231. So that will be the new value because of that note we were told. So the fair value is 231 because we have revalued. You will no longer use that cost. So accumulated depreciation will now be based on the revalued amount. You don't use the cost now. You take 231 because we are using revaluation method. divide by the number of years remaining. 11 years are remaining. So it will be 231 divided by 11 years. So what we are left with is 210. Is it 210? 210 becomes the carrying amount. I hope it's 210. H37 divided by 11. Yeah, 210 is the carrying amount. We go to recoverable amount. Let's get the fair value at the end of year 2. What is the fair value at the end of year 2? It is now 175,000. 2002, 175,000. So the fair value year 2 is 175,000. Now, value in use, again, it was not given. Which is now the higher? It has changed. Okay, the higher is fair value, the 175. But now I come here, step 3. Compare carrying amount to recoverable amount. What is our carrying amount? 210. What is our recoverable amount? 175. So in this case, carrying amount is greater than recoverable amount. Therefore, there is revaluation downwards. Y is of 35,000. How did I get 35,000? I take 210,000 as the carrying amount and I minus recoverable amount of 175. So the revaluation, remember in example 1, there was a revaluation upwards, surplus. Now there is a revaluation downwards or deficit. Revaluation downwards, also called deficit. Now, of 35,000. Next step is step 4. Step 4, we call it accounting treatment. Step 4 was accounting treatment. Now, what is accounting treatment? We follow the rules. Sorry, I'm in the wrong place. So, we follow the rules. There is revaluation downwards for an asset that was previously revalued upwards. Let me re-explain. In year 2, there is revaluation downwards. But in year 1, there was a revaluation upwards, if you remember. Now, it meets the principle that we learned. There is a revaluation downwards for an asset that was previously revalued upwards. Therefore, the accounting treatment is you have two debits. Debit, revaluation reserve, and debit, income statement. We say there are two debits. If it is then you credit asset account. So take note of that. Now, how much do we credit? We credit the 35,000. We credit the 35,000. Now, the total of the debit should also be equal to 35. Now, in year one, I'm stressing that. Year 1, there was a revaluation reserve of 11,000, which was credited. But you are told at the end of year 1, there should be a transfer of excess depreciation of 1,000 from revaluation reserve. Let me read it. Now, there was revaluation reserve of 11,000, but we transferred 1,000 out of 11,000 from revaluation reserve to retained earnings. Now, my last question to you people, type for me in the chat. If the revaluation reserve was 11,000 and then we removed 1,000 from revaluation reserve, how much are we remaining with? The balance, I want an answer in the chat. The balance in revaluation reserve after transfer of 1,000 to retained earnings is 10,000. Thank you. It is 10,000. 11,000 minus 1,000. Okay, so I'm quoting these. So that gives you 11,000. So you bring that 11,000. So let me write it there. 11,000 minus 1,000. It gives you 10,000. So you clear that. 10,000 is what you bring there. That is the balance. And then the balancing figure becomes 35 minus 10,000. That is the amount that goes to the income statement. That is the amount that goes to the income. Sorry, that is the amount that goes to the income statement. This is a balancing figure. Now, to enable us conclude in this question, let us look at, in 2 minutes, extract of income statement. Remember, we are looking at what goes to the P and L. What goes to P and L. So that you don't say you did not know that. What goes to the P and L? There is a first year. There is the year 2001, and there is the year 2002. 2001, so I'll have year there. The period year. Year 2001, I'm looking at extract of the income statement as we conclude. We are now concluding. There will be an expense which is called depreciation. There will be an expense called depreciation stroke amortization. You know depreciation is an expense. I believe everyone knows that. So in 2001, there will be an expense. We said it is how much? Year one. Where did we calculate it? Here. Year one, depreciation was 20,000. Year two, depreciation. Year two, depreciation is 21,000. You have earned all the full marks for the income statement. So what goes to the income statement is amortization, 20,000 in the first year, 21,000 in the second year. Next, extract of statement of changes in equity. Okay, extract 2001 and we have 2002. So beginning of the year, beginning of the year. So beginning of the year, how best can I bring this? Okay, we had revaluation reserve. Revaluation reserve. Okay, let me change the arrangement for extract. Sorry, I think the best way to do, because you know the format of statement of changes in equity, let me have a column for revaluation reserve, and I have another column I'm looking at the best way to place it. Another column for retained earnings. And then we have total. I think this is the best way to bring it out. So I can, so that the extract of statement of changes in equity is clear. Now, beginning of the year, beginning of year, 1st October 2000, there was a revaluation reserve of 50,000. That was given in the question. Let me just take you back to the question. I know we are tired, but let's just go. There was on 1st October 2000, 50,000 in the related sum. This was revaluation on that date. So there was revaluation of that. And then add revaluation surplus. It was 11,000 in the first year. And then transfer from revaluation reserve to retained earnings. We are transferring 1,000 from revaluation reserve and we are taking it to retained earnings. So what is the balance at the end of the year? End of year one. End of year one is 30th September 2001. So 30th September 2001. What is the balance in the revaluation reserve? 50,000 plus 11,000 minus 1,000, which was being transferred. Here, the retained earnings will be the 1,000. Of course, the total you can all get. Now, and then that is the balance at the end of year one is the balance at the beginning of year two. I hope we all know that. Balance at the end of year one is the amount beginning of year two. So beginning of year two starts on 1st October 2001. So the closing balance in year one is the opening balance in year two. I believe we are resonating well with that. Now, there was ULEZ revaluation. Revaluation downwards. ULEZ in year two, there was a revaluation downwards, if we recall. Year two, there was a revaluation downwards. Now, in the revaluation downwards, I'm just trying to see how to best account for it. Revaluation downwards, we have the amount of revaluation downwards, which was being transferred from revaluation reserve, was 10,000. If you recall 10,000, let me use a formula. 10,000, where was 10,000? This one, 10,000. So that is 10,000. So what is the value at the end of the year? The value at the end of the year is 30th September 2002. So the value at the here, there is 0. The value at the end of the year, here it will be revaluation downwards minus revaluation downwards. It leaves us with 50,000. And this other one leaves us with 1,000. Of course, the totals, we can get them. 50,000 Here the total is 11,000. Here the total is 1,000 minus 1,000 because there was a transfer. Here the total is plus 1,000. The total is plus 1,000. I just transfer that. And that is statement of changes in equity. Extract means part of. Finally, extract of balance sheet of statement of financial position. Now, extract of statement of financial position, I'll have 2 years, 2001, and I'll have the year 2002. We are done. So there is the PPE. PPE, you less accumulated depreciation to give you the carrying amount or the net book value. Let me not call it PPE, we call it cost of an asset. And this one we have started with assets. So the cost of the asset in year one, the cost was 240. Depreciation was 20. And then there was increase in value. Carrying amount was that minus that. But remember, there was an increase in value. So the value of the asset, there was a revaluation upwards. And we were told at the end of every year, we increase the value of the asset with the amount of revaluation upwards. So the value, revalued amount, because we are using the revaluation method, revalued amount is therefore equals to the carrying plus the revaluation surplus. So the revalued amount is 231. And this 231 is what we take to the second year. And then we deduct depreciation of the second year. Depreciation of the second year is 21,000. To give you 231 minus 21. So gives you 210. And then you less revaluation, okay, stroke, less revaluation downwards. Revaluation downwards. So you less revaluation downwards, it was 35,000, if you recall. So it gives us the revalued amount is 210 minus 35. So your balance sheet must give you the fair values. Your balance sheet must give you the fair values. And we said the fair value at the end of year one was 231,000. That is where we started from. The fair value at the end of year two was that. Now equity, there was also equity. So you show the equity, there was revaluation, reserve, and there was retained earnings. Revaluation, reserve, and retained earnings. You just transfer from here. So what was the revaluation reserve? Revaluation reserve at the end of year one was 60,000. At the end of year two, retained earnings and 0. So that is what we have. And that brings us to the end of IAS 16. In summary, in conclusion, what have we learned? In subsequent recognition, you can either use cost or revaluation method. So in cost method, we have seen what the cost of an asset minus accumulated depreciation. And then we have said, there are 4 steps that you should always try to remember. Step 1, calculate the carrying amount. Step 2, calculate the recoverable amount, higher of fair value and value in use. Step 3, compare recoverable amount to carrying amount. If recoverable amount is more than carrying amount, revaluation surplus. If carrying amount is more than recoverable amount, revaluation downwards. And that brings us to the end of the standard. Thank you. And I know it was a long session, but we had to cover everything there. We can stop from there.